It does take us to our talk of the tape, the great bounce back for stocks, and whether it is, in fact, sustainable. Let's ask Adam Parker. He's the CEO and founder of Trivariate Research with me here at Post 9. Good to see you again.
Great to be here.
I get the feeling from reading your notes of late that you're not so sure this is sustainable, and you're maybe a little more cautious than you've been in a few months. Is that fair?
Yeah, when we talked, I think, last week on halftime, I think the conditions are still the same. I see about equal chance we're at 10% up versus 10% down from here, and it makes me a little less confident because I think the data are mixed. I think if you really look at it, for every good thing I get a slight little upside maybe on retail sales, I get a little down on housing. It just seems like there's some good and some bad, and enough to feed both bulls and bears at this point. So
well,
I don't have
you have to get to a soft landing somehow, right? Isn't that kind of the definition of? Were you looking for the economy just to keep roaring along and figuring that the inflation story was going to work in your favor even if it did?
I think just erode, not implode. That's kind of the base case, that we slow down from what was the highest nominal GDP in our lifetimes, right? So we knew we were going to slow, but the question was just at what pace. And I think the good news is that you don't have a synchronous contraction because so many things the cycles were, at different times. Housing is a little bit different cycle than autos, a little different than semis, a little different than electrification industrials. There's enough things that are working that I think things can be positive. I think the earnings will grow. The Street's got, I think, 278 in earnings next year, bottom up. So 1584, what is that, about 18.6, 18.7 times the number? Maybe it's 19 if they're a little too high. Seems okay. I don't think it's like crazy expensive where you're like, wow, this is awful, especially as you pointed out when, bond yields come a little bit lower. So I think it's okay, but I just don't feel as positive about the risk reward as we did, 12, 15 months ago.
Well, I feel like if there's an area you're getting more concerned about, it's tech.
Yeah.
Where, now we've gotten a couple notes in a row from you that one of the headlines here today is why technology investing is getting riskier. Now, how do we get from, in a few weeks, right, from wanting to still be overweight mega cap tech to now it's getting riskier and we're riding the surfboard. Now it's maybe time to put the surfboard back on top of the car.
I think when you run a portfolio, a guy who's got 40, 50 stocks trying to beat the S&P long only, and they've been correctly, benefiting from AI and semis and software. I think what their debate is going to be, and I had a big debate with a big long only manager earlier today, is how much do I lighten that? If we worry, not that we get stagflation, but just that others think it has a higher probability, the first thing that's going to get sold, two things that get sold are tech and energy, and what's going to get bought is staples, kind of healthcare, maybe a little bit of utilities.
Why are you still using that word stagflation? I mean,
to the extent the economy slows and inflation picks up cyclically, people will worry about it. I don't think that's the base case, nor do I think I should position for it.
The economy slowing is not stagflation.
No, but the question is if people, right, what do you think right now? Half think no landing, half think soft landing, and we're somewhere in that.
Were you not convinced by what the Fed chair said last week where he said no stagflation?
Should I ever be convinced by what the Fed chair says? I mean, isn't that, what do you mean? Like, I should.
But there are no signs.
Should I position my portfolio listening to the Fed chair?
No, but I mean, people have been, getting crazy about the stagflation word.
In the last 2 weeks, if you like, in my world, if you searched on it the previous 6 months, there were 0 mentions, and now it's like rocketed in the last 2 weeks, and it was all because that one day had a little bit of like a high PCE and a little bit of a weak GDP, and all the big houses lowered their GDP numbers. So I don't think it's the base case. I'm just saying tech's ripped. It's higher beta than ever. If you take stocks and you look at their bounce, versus the market or the beta, half of the stocks that are 1.2 beta or higher are tech. So if we do somehow get a little bit of like a hawkish thing or a little bit of an economic slowdown, just directionally from where we are, that's going to go down more than normal. So I think guys who have done well, who are really up this year, 7, 8, 9, 10, are saying, all right, I don't want to like lose it all in. Just like we had the great, pickup here. If we get a bit of a 4 or 5% downdraft again, like we were below 5,000 a few sessions ago, I think people are like, you know what, maybe I should buy a little consumer staple that's got something interesting, or maybe healthcare services that everyone hates, and I'll sell my Palantir, which was on our list of risky stocks in the note you talked about before it blew up today. So I think it's that kind of logic that you're trying to just protect yourself a little, just kind of protect that. It's gotten a little riskier in the portfolio.
So we had Brad Gerstner of Altimeter on halftime. Right, he's a growth manager. He invests in a lot of mega cap tech stocks. Here's what he said he's doing in terms of his positioning, and in reaction to what Adam has written about protecting your capital. Listen.
We've taken down our own exposure by 1,000 to 2,000 basis points in our hedge fund and our long-only fund, right? And that we've done that by both adding shorts, custom basket shorts. We're worried about some things in the world, as well as reducing some of the overall position sizes. Again, this isn't about all or none. This isn't about 100% net long or 0%. This is simply about going from 80% net long to start the year to something closer to 60% net long today.
Yeah, makes a ton of sense. Makes a ton of sense, man. To me, I think that's you're always trying to look. If you're a growth manager, you want exposure for the next several years to AI, software, life sciences, electrification, industrial. Like you're going to want to be long those stocks, but there are times where you're going to try to manage the risk.
And I think this is one of those times?
I think there's a little bit more risk management involved today than there was 6 months ago. Yeah, I do. And that's why we're indicating that. If I were correctly overweight a ton of this stuff, I'd be lightening a little bit just until I get more clarity on the direction of how much the economy is eroding and where estimates are going to come out. I still think a number of companies are going to have margin expansion, as we talked about for a long time. I still think that the Fed's more likely to be accommodative than not. That's a good cocktail for equities.